What's up, y'all? Welcome to the stream. We are back. Back and better than ever, baby. With some good old Pokemon music going on in the background. I'm super excited to bring this to you guys today. Alright, so what are we doing today? How's everybody doing? Probably pretty good, I hope. If you happen to pop by to the stream, say hi. Say hello in the chat. I do have chat open, so I will try and read it if somebody chats. But yeah, so today we're going to be doing some interesting things, as the stream says. Let me pause the music, actually. So today we're going to be doing some interesting things. I want to see if ChatGPT can help me become a very good stock picker. And I'm going to see if I can use ChatGPT in order to test some portfolio theories, to test some philosophies. Again, just before going into this video, I am a staunch disbeliever in stock picking. I think it's a terrible idea and you will probably lose doing so. But I figured for entertainment, this would be fun to do. So I'm going to see what ChatGPT can come up with and if it can create a better stock portfolio or if it can teach me the concepts I need to know to become a better stock picker. So let's see what we can learn from it. And then after that, we're going to be checking out a news story. So I actually think we're going to do this first. So I wanted to see if so recently in the news, there has been this story that college graduates in the US actually are seeing a higher unemployment rate than non-college graduates. Which is insane when you think that the entire point of going to college is in order to be able to get a job at the end. So I thought that was just a crazy news story, and I wanted to investigate if that is happening up north in Canada where I live. And yeah, so that's kind of the vibes, that's kind of the idea. So let's take a look at this first one. I just want to know, first off, what is the unemployment rate in Canada? Just the general unemployment rate. So 6.9% remained unchanged from the previous month. And let's see, labor force survey. So the total number of employed people increased and the unemployment rate went down, which is good. So that was June. What happened to the July one? I thought they'd give you the most recent one immediately, because there should be a more recent one. Okay, so while that's loading, let's look up U.S. graduate unemployment rate versus non-grads. Gen Z men with college degrees, specifically men, the men problem. Gen Z men with college degrees now have the same unemployment rate. You guys can't even see this. What am I doing? You guys can't even see this. Okay. So let me restart. Let me do that all over again. All right. So first up, we're looking at Statistics Canada. I want to see what they have to say about this. Search the daily. Let's do labor force. The labor force survey in July. So that went down 0.2%, which is good. No, that's not good. Sorry. The total number of employed people in July fell, and the unemployment rate stayed the same. So not much is happening out here in Canada, but this is interesting. The employment decline was concentrated among youth from 15 to 24, and employment among core age people was a little changed. Employment was down by information, culture, and recreation, and construction, which is not good because Canada is a place where construction is something that needs to be happening. There needs to be more of it. And that being down is problematic, especially in the summer when you would think you can get students working and all this stuff. But anyway, I wanted to see what the U.S. graduate employment versus non-grads was. And then I found this Reddit post, and then that led to this article by Fortune. So this is just like this is crazy to me. I remember hearing about this and I was like, what the hell is going on? So specifically Gen Z men with college degrees now have the same unemployment rate as non-grads, which is insane because of first of all how much debt you have to go into to get like your college or university degree, especially in the US, almost anywhere. Like there is a way to do it where you go into less debt, or you get like scholarships or whatever. But very, very, very few people actually do that. Like we talk about it, but it's probably less than 1% of people who get some sort of financial assistance going to education, and the grand majority end up going into debt to do so. And now it's literally less employable than non-college educated people, which is crazy. Um, the one thing I will say though is I think this the total earnings still of someone with a college degree end up being higher. This could just be like a moment in time situation where because of AI and all this disruptive stuff that this is a problem and that this might go away or this might improve depending on how the like AI thing pans out. But it's really interesting to see and really problematic, honestly. Um, so let's see what we can find here in the article. Gen Z is increasingly slamming their degrees as useless. Yeah, I've been doing that for years. And new research indicates there may be some truth when it comes to the job hunt. The unemployment rate for males ages 22 to 27 is roughly the same whether or not they hold a degree. Employers drop degree requirements and young men ditch corporate jobs for skilled trades. Gen Z is struggling to break into the entry level job market, but young college male graduates may be hurting the most. The most recent data from the Federal Reserve indicate that the unemployment rate among recent college graduates is on the rise at about 5.5%. Although it remains lower than the 6.9% among all young workers between 22 and 27 years old, men with a college degree now have roughly the same unemployment rate as young men who didn't go to college. In comparison, around 2010, non college educated men experienced unemployment rates over 15%, whereas the rate for college graduates was closer to 7. So this was post financial crisis. The previous, I guess, I want to say the previous recession. It's not officially a recession, which is kind of stupid. It's just like kind of a semantics thing, I think, at this point. Um, but let's just call it an economic downturn. The most recent economic downturn around 2010, there was like a 2-to-1 difference for the percentage of people that were able to find work without a college degree versus those with a college degree, which again, crazy. Young men and women are facing diverging employment rates. 7% of college educated American men are unemployed. For women, it's only 4% because of growth in fields like healthcare, which women are more likely to pursue, in part in credit. So this is interesting too. I heard about this as well, that like because of the types of jobs that women gravitate towards, like healthcare, teaching, I think they're called like heal professions. So those professions tend to do better in economic times because they're kind of like always needed. And I've noticed this in my life too. Like I know a lot of people, a lot of women working in healthcare, and they do not really have trouble finding employment. In fact, there is a shortage of healthcare workers. Meanwhile, a lot of men that are looking kind of in the private sector, that are looking even in trades, sometimes it's hard to find work here. So it's just kind of because of the types of jobs that people are choosing, it gets more difficult. And you can say the same thing. Like there's a guy who decides to be a nurse or decides to be a teacher. They're very employable. And I have met lots of male nurses and male teachers that are doing just fine and are gainfully employed and are doing really well. We have a teacher shortage here, so they're doing like just fine in those fields. But it's just because the majority of men tend to not pursue those fields that makes this kind of problematic for them, and that makes it more challenging for them. Women tend to be more flexible in accepting job offers, even if they're not perfectly aligned with their career goals, or are part time, or they are overqualified for it, which is also kind of interesting. Men, on the other hand, hold out for roles that align more closely with their ideal career path, or offer what they perceive as adequate compensation and status. I have fallen into this trap myself. I will say, it's very hard to wrap your brain around going like backwards, which is something that I have felt as a problem because I have not employed education or training. Yeah. So I've felt this as like a personal thing. It's that I have had jobs in the past, maybe for like one reason or another, and I got paid a certain amount in those jobs. And I don't want to accept a job that pays lower than what I was able to get in the past because theoretically I'm more skilled now and more educated now than I was in the past. So why should I get paid less to after having gained more education? It makes it really challenging to go backwards, and I completely understand this. But I also realize too, like depending on what you're doing, if you're changing a career path or if you're just like updating what you want to do, you generally do have to take a pay cut, and sometimes just getting your foot in the door is better than nothing at all, and that's something else to consider as well. And so that is something that I have had to learn personally, and I think a lot of men probably need to learn from that as well. Sometimes you just got to take whatever. Sometimes you just got to take what you can get, and especially in tough economic times like the ones that we're in. All right. So that was an interesting thing. So let's take a look and see if there are similar statistics for Canada, because that's where I live, and I think this is super interesting. Canada unemployment rate for young men 22 to 27, college versus then let's do university versus non-university grads. Similar unemployment rates. Ah, interesting. Is this... No, this is the same article. It thinks it's Canada. Yeah, this is all American. Okay, hold on. 25 to 29-year-olds, that's pretty good. And Statistics Canada. Unemployment rates by educational attainment to 2024. No data for 2025, unfortunately. Total all education levels. Unemployment up to 7.4. Wow. That's not great. Okay, let's how to remove data. Just wanted to filter. Here. Okay. I do kind of want to see all of Canada, but let's just filter just for a reference point that I understand the best, and then we can broaden the filter. Okay. University 7.6, more than trades. Like significantly more than trades, and it's been continuing like that for a few years. Very good data quality. Wow. Okay, so high school and less than high school is still pretty brutal, but trades education are doing, like, people in the trades are doing better. Wow. Honestly, was not expecting to see that. And that's across Canada too. Starting this year, in times of economic trouble, people in with a college or trade education are doing better than those with a university education. And those with a university education aren't doing that much better than those overall, which I can see those two things kind of converging a little bit, which is scary. 25 to 29-year-olds. Wow. All right. So we do, I think that's the best data that I'm going to have. Do we have like 20 to 24-year-olds? Oh my God. Is that real? youth unemployment reached its highest level since 2010. So I knew about this. This is like the thing that's really scary in Canada that I don't know that people are like talking about it or that they're talking about it enough. And that's the youth unemployment rate is getting really high. And like this is a big problem now and for the future because if like having the employment experiences when you're younger really does help you gain the experience and the skills and learn how to work and all of this stuff. And if people are not getting those skills, it can there are statistics that back up the fact that it can really negatively impact their future earnings and their career growth and all this stuff. So there's like very formative and important time for people to be able to find employment, and it's just not happening. It's 14.6 in July, the highest rate since September 2010. Youth unemployment rate has trended up over the past 2 years, and in 2025, it was up 4.3 percentage points compared to 2023. Increases were recorded for both young men, who saw 5.7% increase, and young women, who saw 2.6% increase. Wow. 15, we don't have, I don't like the way that we categorize things here because like 15 to 24 is such a broad age range. Here, 20 to 24. Returning students who were of high school age continued to face the most difficulties finding work, 31.4%, unchanged from last year. The unemployment rate was lower among older returning students and those aged 20 to 24. So still 10% unemployment rate for, call it summer employment. It's kind of rough, but not as bad as the headline number, which is like 14. I'm still really concerned about it though. Despite uncertainty, most workers remain confident in their employment prospects. Interesting. Overall, employees in healthcare and social assistance, utilities, educational services, and construction were most likely to be very confident in their employment prospects. Well, there you go. On the other hand, those in IT, culture, or information culture recreation, 43% employment. Professional, scientific, and technical, 46% employment. Accommodation and food services, 50% employment, and manufacturing, 50% employment, were least likely to be confident. Wow. Employees working in industries dependent on U.S. demand for Canadian exports were 7.1 percentage points less likely to be very confident in their employment prospects compared to employees in other industries. Moreover, employees in industries dependent on U.S. demand for Canadian exports often cited tariff-related uncertainty as a main reason for not being confident. Yeah, that makes sense. Okay, so these numbers like perfectly align with what I was saying earlier, except for the construction one. It was kind of like not super expected, but it is still quite a big industry here, and we'll always need people working in construction. But as I was saying, people in healthcare and educational services, so like healthcare, teaching, and utilities apparently is a pretty big one, which makes sense, and construction are the most likely to be confident in their employment prospects, which tracks with the employment rate, which are these numbers in brackets that they are seeing, which is very interesting. Or were those likely to be very confident? Oh, this is a percentage of people that are likely to be very confident. I see. Okay. Sorry about that. So these numbers in brackets are what percentage of those people, those employees, feel confident about their prospects. So very interesting, and kind of tracks with exactly what I was saying, which is that these jobs tend to be pretty like economically stable even in times of economic trouble, because you always need people in healthcare, you always need teachers, and you always need electricity to be running and water to be running, and you always need people repairing and building things. So those make a lot of sense to me. And these ones, are a little more disruptive with like science, tech, info, culture, recreation. That's like tourism and travel. Accommodation, food services, also travel dependent. Manufacturing down because of tariffs. And our manufacturing sector in general in Canada here has been getting eroded for years. So makes sense. Like all this stuff tracks. Based on additional questions in the labor force survey, 54% of employees from 25 reported being very confident in their employment prospects in their current line of work. 41 were quite confident or somewhat confident, while only 4.1% of employees were not confident. Interesting. That seems low, but I guess that's good that people feel mostly confident that they'd be able to find work. Anyway, yeah, I just thought this was really interesting and like tracks a lot with what I'm seeing. As I was talking with someone about this earlier, and the thing with like the heel jobs is that you have kind of a ceiling on how much money you can make in those jobs, whereas in the private sector you have a lot more upward mobility, but you have the downside of you're much more likely to be laid off in like times of economic trouble, or if you're not performing, it's likely to be. I mean, healthcare can be very stressful. Teaching is very stressful. So I won't say like that there's a comparison of like the amount of stress, but the hours tend to be a little bit longer in private sector than in public sector, where you kind of just like do the amount of work you do. There's more union membership in the public sector, so you kind of, you are very unlikely to be overworked, whereas in the private sector you might be. And so there are trade-offs between all of these fields. And I don't know, I just wanted to I thought that was kind of interesting. And the point I'm trying to make is that I think the heel stuff is more stable, while the private sector stuff can be stable, but requires, I think, I don't know, I'm not going to say it requires more work. I'm not trying to I'm not trying to start a war in the comments. But I think it requires a different type of ability to deal with BS. There's corporate BS, and then there is and there's public sector BS. There's BS in everything, but anyway, I don't really know where I'm going with that. But I think your likelihood of being in a bad position in the public sector is higher than, or in the private sector is higher than the public sector, is what I was trying to get at. Okay. So, in conclusion, it doesn't really seem like the exact same thing is happening yet in Canada as it is in the US. But what's interesting is if you look specifically at people in trades and construction and apprenticeship type programs, their employment rates are higher than people who have a university degree, which is very interesting to me. And I think that kind of trend is going to continue to diverge with AI and all this stuff. And in the future, I think you will probably see what you're seeing in the US, in Canada, which is that people who go the trades route or apprenticeship route tend to be more employed than those who ended up going to university and spending the tens to hundreds of thousands of dollars getting educated, which is crazy and sucks. And I wish that was, I wish someone had told me that a little bit sooner, but there's, you can't change the past. You can't, there's no point in bringing the past into today. Today is a new day, tomorrow's a new day. You cannot change what you did in the past, but you can change what you do in the future. And I think having the information to make those decisions is important, and will help you hopefully make decisions that are better in the future. Whether or not you consider going into a trade or whatever to be a better decision, or you continue pursuing jobs in the private sector and in technology and all this stuff. All right. So that's that. Let's go. I wonder, I don't know. I feel like there needs to be a little bit more of a story here, but. Oh yeah, there's one other thing I wanted to. Financial Times outgoing. on personality traits. Yeah, that's the one. Yeah. It's not the one. This one probably works. I don't know where the data is. Like the most interesting part were the charts, and I can't see them. No, let's check one more time that I'm not missing something. I feel like this is not a recent enough article because I remember reading about this and I thought the article was much more recent. Is this one? I think that's the one, but I don't. All right. I want to see someone like yelling at me. Okay. Basically, because I don't have an FT subscription, basically, as this says, there was a Financial Times article which highlighted a decline in conscientiousness among young adults, including Gen Z. This decline indicated a drop in traits like discipline, organization, goal setting, and is seen as potentially impacting their success in various aspects of life, including relationship, work, and overall well being. I thought this was super interesting. There were some charts. I don't know if I can find those charts. No, we can't see them. There were some really interesting charts that showed that basically that people in Gen Z were, as Google says, less out. They were less outgoing, and generally the youngest generations are like the most outgoing of any generation. And this is really problematic because it's showing that people are kind of becoming more introverted rather than extroverted. And, you know, the younger you are, the more extroverted people were in the past. But because of various things, whether it's the internet, whether it's like fear of rejection, whether it's COVID, and there was a pretty steep drop off when COVID happened, it's leading to problems. And all of these traits are associated with doing well in the workplace, doing well on various things in life, and just being successful overall. And so it is quite concerning. And I think it plays into the thing that I was talking about before, which is just generally one, the poor employment statistics for young people and the poor employment statistics for specifically university educated people. So I just thought that was also pretty interesting. Okay, let's move on. Find ChatGPT. Okay. New. Okay. Let's go here. All right. Oh, I kind of wanted to do this fresh because I think it's going to know a little bit about me. So I wanted to do like a fresh account. Okay, hold on. ChatGPT. At least one that I like haven't used before. Log out. Log in. Let's continue with Google. I hope it doesn't just automatically log me in. It does. Damn it. Sign up. Google. Why do you have my cookies saved? Damn it. Damn you. Delete. Okay. God damn. Log in. Sign up. Google. I swear to God, if you have my cookie saved. Oh my goodness. Why does it have my cookies? I don't want you to have my cookies. Sign up for free. Okay. Authenticator, do you have my cookie? 3 cookies. Okay, that's why. Delete all of them. Create new account. An error occurred. Perfect. Continue with Google. Come on. Oh man, now I'm getting the error friggin' occurred thing. Okay, hold on. Continue with Google. Error occurred. Oh, bloody hell. Chat GPT. Never thought it'd be so hard. Here. Okay. Wait. Okay. Sign up for free. Google. Come on. Log me in, bro. Incognito. Chat GPT. Dude, this is so annoying. Sign up for free. Continue with Google. Thank God. Okay. What Google account can I use? Gmail. I don't know what the password is. Oh, open the app on your phone. All right. Two-factor authentication is awesome. It doesn't take long at all. Yes, it's me. Thank you. Continue. Yep. Tell us about you. Can I just not? Okay, my name is going to be Beth Jesus, and my birthday is going to be 01/02/1929. There you go. Is that going to be like, that's not you? Oops, an error. Come on. Okay, fine. I'll use my actual name, and then I'll make up a year that's more realistic, like 1990. Come on. Another error. Why is it? Bro. It's driving me insane. This is actually driving me crazy. I just want to use ChatGPT in a different account. Okay. We're going to try this. I'm going to try just doing this here and then see what happens. Okay. Hi. I want to try and create a stock. No. I want to learn how to find inefficiencies in the financial markets in order to profit from them. How would I be able to do this? And can you help me learn about finding inefficiencies inefficiencies and trading on them. This is a complex but fascinating area that blends financial theory, data analysis, and practical trading strategies. Here's a step-by-step breakdown of what you need to learn and do. What are market inefficiencies? There are situations where asset prices deviate from their true value due to information asymmetries, behavioral biases, regulatory or structural constraints, timing delays, and price reactions. Illiquidity or market fragmentation. Identify and exploit them before they're arbitraged away. I don't know if that's like really what I wanted to do. I guess maybe. Efficient market hypothesis, semi-weak, strong, semi-strong when weak and strong forms. Learn the risk-return trade-off in basic asset pricing models, the capital asset pricing model and the Fama-French model. Market microstructure, how trades are executed. Investopedia, a random walk down Wall Street. Random walk is a statistical method, isn't it? Market microstructure theory. Study types of inefficiencies. Mean reverting stock pairs. Pairs trading. Behavioral biases, overreaction to earnings surprise. All right, contrarian strategies. News reaction lags, delayed price move after economic report. Event-driven trading, buy dips, fade pops. Temporary price dips from large block trades, cross-listed assets with different rules or taxes, arbitrage between exchanges. Learn quantitative and statistical tools, Python and R for data analysis, regression time series, co-integration, machine learning eventually. Backtesting, alpha excess return above a benchmark, Sharpe ratio, return per unit of risk. Tools, Python with pandas, NumPy, stats models, scikit-learn. And Backtrader Quant Connect zipline for backtesting. Need reliable market data to find patterns and test strategies. Yahoo Finance, free. Alpha Vantage, IEX, Cloud, Quandl, Bloomberg, Refinitiv, etc. Identify and backtest strategies. Mean reversion between two stocks. Momentum by recent winners. Earnings drift, price movement after earnings surprise, counter anomalies. January effect, day of week effect. I don't know about that. Develop execution and risk management. Learn slippage and transaction cost. Position sizing, portfolio diversification, stop loss and take profit mechanisms, paper trade or simulate. Use a paper trading platform, Thinkorswim Interactive Broker to simulate your strategy in real time without risking money. Once you validate a strategy, consider trading it live with a small capital to begin. Understanding and detecting and writing Python code for backtesting, choosing data sources, creating dashboards or alerts, learning market theory step by step, reviewing and improving your trading ideas. Would you like to start with a specific inefficiency, mean reversion, or news trading? Begin learning the fundamentals in more detail, jump to coding and analyzing a strategy together. I personally am most curious about the coding stuff. So Python code for backtesting strategies using free data sources. I want to test. What do I want to test? Can you provide a sample stock strategy at a sample strategy at random to test and see the results? I don't know. Because we can definitely do some Python. Let me open up VS Code. All right. Let me go to my files, open the right folder. While it does that, not there. Here. Select. Okay. Great. Let's dive into backtesting a sample training strategy using free data and Python. Y Finance to fetch free stock data from Yahoo Finance, Pandas, Matplotlib to visualize simple moving average crossover strategy. Moving average crossover logic. Buy when the short-term moving average crosses above the long-term moving average. Okay. Exit when it crosses below. This is a classic momentum following strategy. All right. I think I have all of those except Y Finance installed. And I guess you guys probably want to see. All right, let me make up a name for this. Let's do backtest underscore moving average dot py. And let's throw it up over here. Cool. And then we'll open up a terminal and install these. Let me zoom in a bit, maybe. Yeah. Okay. First, install required libraries if not already installed. Working on it. Python code, moving average crossover backtest. Import Y Finance as YF, easy. So we're doing an Apple backtest from 2020 to 2024. Short window 50, long window 200. I don't really know what those are. Oh, they're just setting these variables to certain values. Download the ticker from start to the end. Data short moving average. I see 50. So the data at close, rolling window, short window, dot mean. The long data, the long moving average, rolling window, long window dot mean. So that's on every, it's taking the data from this period. So it's creating like a frame of time. And then it's taking the close. So short MA. So it's making kind of a list within the list. So the short moving average, it's probably going to do, because this created a whole bunch of data, like one for each trading day into this list. And then this stuff is creating more data specific to the short moving average and the long moving average and saving it into this data frame based on the mean from that day, or is it just trying to provide the average of that? So the short window, okay, so it's taking the average of the 50-day window and then calculating the average and then sticking it into that variable. Fine. Signal 0. Signal short window when the short window is greater than the long window. For integer data position, data signal difference. I don't know what these are. Okay. So we're running, my coding knowledge is running out. Change the ticker to other stocks. Adjust the short window, long window parameters. Add transaction costs, simulation, add stop loss type, probability logic. Try different strategies, mean reversion, RSI, etc. Okay. So this is all like technical trading, basically. I'm just curious like what this will look like, when we actually run the code and if it will like actually look like anything interesting. Okay. Well, that didn't do anything. Uh, strategy return. So market return, really 2.75 times. That's kind of crazy. Hold on. Apple buy sell signals. Well, I don't see them. There should be buy sell signals on this chart because the moving averages did cross over a few times. Strategy, okay. Something's going on here. To access, I'm just gonna literally dump this into ChatGPT and be like, it didn't work. The G return part didn't work. Due to chained assignment, use -1 to access the last value, which will change behavior. Likely due to logic or shifting issues in signal generation. I don't know what that means. Use LOC to avoid chained assignment warnings. Use ILOC -1 to access the last value. Review signal shift logic to great. No, it's still generating. So what did it change? So it was doing signal stuff. Okay. Daily return, percentage change, plot, cumulative strategy, buy signal, sell signal, label, close price. Buy sell marker, strategy return, print performance, market return. I don't know if that will fix it. This is what the kids these days are calling vibe coding. So I'm going to vibe code my way to above average market returns. So that doesn't really seem to be working. What happened here in the middle? That looks like it lines up with like the buy sell signals. Okay, so this is funny. I don't understand. So it just like buys here because the short moving average. Well, don't you want to buy? Okay, you want to buy when the short crosses over the long moving average. So like momentum's going up. Okay, that makes sense. So momentum's going up here, but this just like took some time to calculate the average. Okay, fine. So you buy here. You sell here. So you're only making. So we went from 120 to like 140. It's not very much. And then you go down, and then you go back up here, and then don't see a sell point yet. But this one doesn't seem super great because, well, I guess you can't know for sure, like if this down drop here and will end up being lower, or that one will end up being lower. But I could see this being a problem when you end up with something like this, where it's like the short moving average just barely crosses over the long moving average. So you buy it, and it goes down, you have to sell. And then it barely crosses over, and then you have to sell. And then you just end up losing money a whole bunch doing that. Strategy return, I believe that it was only like 40% versus 163% for the market. Okay. Let's see what it said. The shift one was either missing or replaced. You can't act into signals today. Signal generation had a chained assignment, so the signal column Was it reliably updated? The use of -1 is not future proof for getting the last value in a series. Try different tickers for different behavior. Tune the window for better results. Why would you tune the windows? Is the short window just taking the average price over the past 50 days? Let's see. Calculating a 50-day moving average of stock closing price. A long window is a 200-day moving average. They directly impact how the strategy behaves. The goal is to find a configuration that works best historically and ideally out of sample. Does everyone always change how fast or slow the moving averages react? Behavior, very responsive, lots of trades, good for volatile momentum stocks, but noisy. Slower, smoother trends, fewer trades. Very slow, misses short-term trends, less whipsaw. I kind of want to try the very slow one. In trending markets, longer-term strategies may outperform. In choppy markets, shorter-term strategies may avoid getting whipsawed. Interesting. Test too many combinations and only pick the best result. You might just be fitting to random noise and historical data. This won't hold up in live trading. Okay. Let's see. I just want to do this one, the like super long version for Apple. What does that look like? I think that's a little bit better. Like the returns are slightly higher. And here, oh, interesting, it sold like perfectly at the top. Because this downtrend took longer to register. And it just so happened, and there's a longer term uptrend. So it actually managed to somehow sell like right at the top, which is kind of crazy. And then it bought on the way up again. So I guess this is what it beats, because the market that we're looking at, like Apple specifically, is kind of a longer term trending stock. So you're going to see this difference of the moving averages. Like they'll kind of work out a little bit better the more like longer view you have on it, which makes sense. Strategy was still way underperforming the market. So, okay, let's make it like super volatile just for funds. 10 and 30. See how that does. Not bad, not great. Lots of trading. And then you also have to deal with the price changes. Oh wow, that's actually the best. Has the best return. The high frequency trading, which is rough. Okay. Well, I don't really like that result because that doesn't conform to my beliefs. So let's do Tesla. I wonder if you do like a really short. So Tesla's a little bit more of a volatile stock, right? So you want to do like a short window. If it moves up and down a lot and like your trade gets executed based on how the short window is doing versus a long-term average, which would still be up, like you don't really want, like this is just my opinion, but I don't see why you would want the thing to trade a lot if your expectation is generally up and to the right. So why wouldn't you do something like 150 and 200 instead, where it's harder for it to make a trade? Oh boy. Okay, I don't think that worked. Oh my god. Okay. I have executed a buy high, sell low strategy. Oh no. Oh no, that is not good. Negative 8% versus 700. Ooh, yeah. All right. What if we did that? Much shorter window versus much longer window. That is also a terrible strategy. 12%. Okay. So this moving average strategy does not seem to be working very well for us because Tesla is so volatile. What does it say about choppy markets? Choppy market shorter term strategies may avoid getting whipsawed, and trending where longer term strategies may outperform. Good for volatile momentum stocks, but noisy. 1030. But that's, oh yeah, that was what we tried with Apple and actually worked. But that, I won't even, like, Apple's not even a volatile stock, so. Oh, interesting. So this one actually got quite close to the overall performance. But it's interesting because you still would have just done better off. You just bought the stock. Okay, so this one, there's like a few problems, which is when the stock got extremely overheated, it bought at the top. Here it bought high, sold low. Wow. Yeah, I see the tighter correlation and like the crossover here. The issue with the long is that it takes a while to crossover and then like I would want it to sell based on like the steepness of a curve. Like if here the curve is it's steepening and then it starts to decline. So you would want like the derivative of the long moving average basically. And if that starts to the rate of change, the second derivative, you want the rate of change of this as that starts to decrease, the increased rate of change starts to decrease, then you would want to sell. Interesting. This one is just like crazy volatile. Just went up, down, up, down. There's still a lot of moments here where it's like buy high, sell low. This one's buy low, sell high, so that's fine. But like you want to avoid these buy high, sell low kind of random spikes. So again, that would you'd probably have to somehow normalize the steepening and like the super sharp swings of this curve. I don't know how you would do that. We make the short window like 20 and 30 instead. No, that does not perform as well. Okay, what if we make the short window even shorter? I can't imagine that would do well. Oh my god, that did do pretty well. That's actually, I think that's the best so far. Extremely volatile, but okay, so this actually interesting. So this normalized those really high points a little bit. Like when there's these super sharp spikes and declines, like it does a little more buy high, sell low situations, but it reacts faster to those price changes. This one is also a buy high, sell low somehow. Buy high, sell low, buy low, sell high, buy high, sell low, buy low, sell high, buy high, sell low, buy low, sell high, buy high, sell low, buy high, sell low, buy low. Okay. Still doing too much buy high, sell low, but that's getting quite close and that's super volatile. Well, if we made the long window even longer, I don't think that would make a big difference. Make this like a 2. It's like insanely volatile. Whoa. Okay, that seemed to do something. 2-day moving average. Okay, so that normalized this one a little bit. So this one exits those buy high sell lows very quickly. This is basically just like at this point, I don't even understand how this works. Because the moving average is going to change a lot. So anytime Tesla stock goes above this moving average, basically, it will buy. And anytime it goes below the moving average, it will sell. Sell, buy, sell, buy, sell. Yeah. So now we're just correlating with the stock and the long run moving average. And interestingly, that outperforms. What the heck? So if you just the 30-day moving average, so you can really momentum trade Tesla, or at least historically. If you just if you sell when the stock goes above the long run moving average and you buy when it goes below, or the not the long, the like 30-day moving average, you outperform historically. I wonder if the same can be said for the entire stock market. I doubt it. Not bad, not great. You were outperforming in the beginning and then started to underperform a bit. Because this was super high volatility, so it was probably good to momentum sell on the very high volatility. And then buy, sell, buy, sell. So this again, this is just... It's such tight margins though that like... Yeah, 46 versus 50. Okay, well that was interesting. Honestly, I feel like that was interesting. Oh shit. I did not want it to do that. 1 second. Great. Why did it go back? Oh, it's because that's not my incognito window. Where's my incognito window? Here it is. Okay. Oh, I'm going to lose this chat now. Damn it. Whatever. Timing of signals. Different window lengths change how fast or slow it reacts. What works for SPY may be terrible for Tesla. Slow moving versus volatile growth stock. Actually, not crazy. What is per asset per market regime? In trending markets, longer term portfolio. Be careful overfitting risk. If you test too many combinations, only the best result must be fitting to random noise and historical data. This won't hold up in live trading. Was out of sample testing. Alright. I swear to God, I tried to log in and it just didn't let me, but fine. I'll try again. This is really interesting, actually. This is like, these are all things I've always wanted to like test out, but I quite frankly never had the coding skills to do so. Yeah. Oh, please tell me you saved my conversation. No, I don't think it did. Damn it. I also realized how annoying this is going to be for me later. Like if I want to go back and actually like look at this in my free time, I'm probably going to wish that I had just done this on my personal account. So let's close this window and go back to my personal account. Cool. Damn. Okay, hold on. I'm gonna go back into my stream and see what I asked ChatGPT. What did I ask ChatGPT? Working on a stock prediction model for your dissertation. Oh, really? That's kind of cool. I know nothing about this, so hopefully you're probably screaming at me, being like, "What are you doing?" But that's pretty cool. Okay, I see. It's interesting. Okay, there were people watching. The views have now dropped off because I'm dilly dallying, which is nice. I'm not doing a good job of holding people's attention. But yeah, okay. Let's just go back to this. I'm ah ah. It's probably not gonna find this super interesting. Here, let me just pull this up. Okay, let me go back. Where was it? Where was I messaging ChatGPT? Okay, I'm just gonna copy this. Hi, I want to learn how to find inefficiencies. Why can't I spell? Indices in the financial markets in order to profit from them. How would I be able to do this? And can you help me learn about finding inefficiencies and trading on them to... Okay, let's just do that. Okay. Cool. It's going to give me a bunch of stuff, and then we can go to my next thing, which was the question about Python. Can you help me? Can you help me write Python code for back testing strategies using free data sources? Can you provide a sample strategy at random to test and see the results? All right. Programming. Well, at least it does like pretty similar like responses, which is good. Help you step by step picking one inefficiency and showing you how to actually test in Python. That way, in the process of identifying, testing, and validating inefficiencies, which is the real skill. Would you like me to start by walking through a practical trading inefficiency example? Yes. Or would you prefer to go deeper into theory and research side? Both. Okay. I think we're going to be back on track here in a second. Thought for 38 whole seconds. Wow. We're really making them work. Really using the water. So I'm trying to test coding strategies for backtesting stocks, but ChatGPT is taking a hot second here thinking. But what I have so far is this code, and let me see, maybe I can learn something about this code while it's doing that. So this was backtesting moving averages. I don't really understand like what is plotting here when it says alpha 0.5. Hold on. I'm going to run this again just to kind of get an idea of what it's doing. Because where does it say alpha? Nowhere? So what are you plotting? Alpha 0.5 label. Okay, label close price. Plot buy sell signals. Plot buy signals, plot sell signals, plot figure close. Oh, we're just plotting the close. And then we're plotting the short moving average and the long moving average. What is the alpha variable in matplotlib? Matplotlib plot function alpha variable. Alpha variable controls the transparency or opacity. Okay. So it doesn't have anything to do with stocks. That's good to know. Alpha. Oh, yeah, it's like alpha for video editing. Video editing term, not stocks. Okay. And then marker, buy signal index. Okay. So we plot that. We plot cumulative returns. Interesting. And then we run that. It'd be nice if the two plots like were different or something. Oh, damn. It really just like did the whole thing. Damn. Using Y Finance with they really like this crossover strategy. So make crossover versus buy and hold. Okay, so we haven't discovered anything because buy and hold still wins. It automatically falls back to a clearly labeled synthetic series if data analysts are looking at a summary stats chart tables in CSV. If you run the same code locally with internet access, it'll pulse back from you. Blah, blah, blah. Do depths in a small reusable framework. Or switch the sample to a different idea. Cross-sectional momentum across multiple tickers. I need to learn a bit more of the theory of this stuff. I don't really understand what the zeitgeist of backtesting and trying to find strategies that outperform the market is. Markets are mostly efficient. Prices reflect available information. So on average, it's hard to beat just owning the markets. Inefficiencies exist. They're small, fleeting, and costly to exploit. But if you find them, you can make alpha. Backtesting, running a strategy on a store that if I had traded this way, would I have made more money? The whole game is come up with an idea, code it, test it on history, see if it looks real or just noise. Objective testing. Humans see patterns everywhere, even in randomness. Backtesting is a way to test rigorously. Risk estimation, not just does this make money, but how bad can it get? Drawdowns and volatility. Hypothesis testing, you're basically doing science on financial data. Okay. What people are looking for. Culture of quantitative finance is about finding persistent, repeatable inefficiencies that survive costs and competition. Momentum, assets going up tend to keep going up in the short to medium term. Value, cheap stocks relent. Fundamentals outperform expensive ones over time. Carry yield, assets that pay you more. Interest, dividend, option premium tend to outperform. Mean reversion prices often snap back after moving too far from the average. Okay. Seasonal stuff, I'm not a big believer in that, but arbitrage, relative value. Pairs trading, ETF versus underlying basket, mispricings, futures versus spot. The edge is tiny. Momentum might give you a 0.3% extra return per month. Yeah. Not life-changing unless you scale or lever it. Interesting, that makes sense. But, okay, so why wouldn't you just... Huber be here. Why wouldn't you just, buy you know, if in most cases, if buy and hold works, like you own the market, why not just own the market but like double or triple leveraged? Because then you're effectively just doubling or tripling your return. Obviously, there is a downside that if you lose half or a third, then you lose everything. But I don't know. It's like you're going to put all this work in and then you're just going to leverage a higher risk strategy when you could just leverage a lower risk strategy that's probably not going to lose half of its value. Maybe I'm thinking about this wrong. I guess if like you have like a robust code or something that does what you want it to do, then running millions of strategy variations. Interesting. Well, how do you run millions of variations? Retail traders many chase patterns without understanding robustness, leading to curve fitting, finding fake patterns and noise. I don't really think I understand what that means. I get that you like chase a pattern and then you don't really understand, like it's just like a one-time pattern, I guess. It's not like a repeatable thing. So you just like fit your pattern to a specific curve and it's not an actual strategy. It's just kind of like a one-time thing. I think that's kind of what this means. Academics document anomalies in journals which traders then try to exploit until they disappear. Every time profitable anomalies found, money rushes in, shrinking or killing it. Okay. Markets aren't totally random, but they're competitive. If you find a real edge, you must be rigorous because fake edges are everywhere. Why many backtests lie. Overfitting. Tuning parameters until it works on past data but fails in real life. Yeah, okay. That's basically what I was doing earlier. I was just like overfitting. Look ahead bias. Accidentally using future information in your backtests. Survivorship bias, only looking at stocks that exist today, ignoring the ones that went bankrupt. True. Ignoring cost or slippage. Small frictions can wipe out profit. If you try 1,000 random strategies, some will look good by chance. Serious quants spend more time debunking strategies than building them. Point of backtesting isn't to find a magical formula, it's to build intuition for how markets behave, rigorous scientific skepticism toward good-looking results, eventually design strategies that can play real-world edges you can actually trade. Most professionals think of it like this: beta the market's natural return, buy and hold index, excess return. Okay. That's the theory. Okay, but like, can you create, I guess, is it possible to create a trading strategy based on news cycles and for example, what news is coming out of the White House, and then trying to determine in the short to medium term what that will affect. The only issue is that if you are too late in making a move on something, you could just be chasing other people's ideas and end up doing a bunch of poor moves. How do you prevent something like this? Is it practical to trade on macro news? Would you be better off just trying to set up a longer term portfolio based on what you think will happen in the economy as a whole, rather than trying to exploit tiny inefficiencies? Can't fucking spell that word. Touched on one of the biggest debates in trading investing: news-driven trading versus systematic longer-term positioning. Can you trade based on news? News-driven quant funds use natural language processing to parse headlines, press releases, tweets, and within milliseconds trade before humans can react. Cool. Event-driven funds, political, economic, and corporate news, merger, regulation, Fed decision, macro traders build these around government policy, interest rates, wars, fiscal spending, and trade accordingly. It is possible, with the devil's in the details. Lag is the main risk. By the time you hear the White House announce blah, high-frequency firms have already traded the headline. They pay for direct news feeds from Bloomberg, Reuters, and react in microseconds. Crowded trades. If everyone expects the same impact, the move often happens before the news. Rate cuts often get priced in advance. Ambiguity. News doesn't map cleanly to price. A tax cut might be good for business, but what if it spikes deficit and bond yields? Market reaction can be the opposite of what you first expect. That's why a human trying to click buy after a headline almost always ends up chasing. Fair enough. Excuse me. How do professionals handle it? Ultra short term, high frequency trading, quant news trading, compete on speed, co-location, machine readable feeds. Medium term macro strategies. Instead of reacting to each headline, build a thesis like White House policy will increase fiscal spending, which will lead to more inflation risk, long commodities, short bonds. You hold positions for weeks or months, not seconds. But then you don't need coding to do that. I guess you can use coding to test things, strategies. Some funds analyze aggregate tone of news and use that as slow-moving input to portfolios. Event arbitrage, niche events, mergers, approval, sanctions, earnings release, so you know the probability tree of outcomes and the trade odds. Long-term macro investing is much more realistic for individual traders. The alternative: inefficiencies versus macro theses. Exploiting tiny inefficiencies. Hard, competitive, often arbitraged away by hedge funds. Macro portfolio building, more accessible using economic knowledge, study cycles, diversified bets. Trading directly on news headlines is almost impossible unless you're a high-frequency shop. Building medium to long-term macro strategies is much more practical. Focusing on long-term portfolios is usually wiser than chasing short-term inefficiencies. Yeah, that's kind of what I thought. I'm worried that I'll fall into confirmation bias here, but if for an individual it makes more sense to trade on longer term outlooks, can backtesting and Python still be useful for learning about past trades and trying to build that into your portfolio and strategy? Even if you're not trying to scalp news in milliseconds, Python backtesting is extremely useful. You can test a macro thesis that would have played out in the past if I overweighted commodities during inflationary spikes. Okay, this is more so what I was looking for. Like, I want to do these like really longer term tests. You can simulate how different allocations affect risk and drawdowns. See how strategies perform in different environments, Fed hike cycles, recessions, crises. Replay 2008 or 2020 with your portfolio and ask what if this happens again. It won't, not the exact same way. Can I find an inefficiency? Can I build a portfolio that holds up across several macro conditions? What backtesting looks like for macro long-term investors. Instead of testing day trading signals, you test big picture strategies like asset allocation shifts. But can you just do this in like Excel? Like 60-40 portfolio versus risk parity versus gold tilt. Economic regime: when inflation is more than 3%, overweight energy and commodities. I feel like that's a pretty good one, honestly. I wonder if it can build me some code to test that. Factor value versus growth, momentum versus defensive, different market cycles on a base. How do markets behave after Fed cuts, increase equities for the next 12 months? And pull long-term data, build back tests, measure cumulative average growth rate, do Monte Carlo simulations, thousands of possible futures. Okay. Example of backtest for macro allocation strategy. Yes, I'd like an example. Can you do one for this situation? I'd like a historical backtest Python example. Can you do one for this situation? When inflation is greater than 3%, overweight energy and commodities, and so that I can see how that performed. But in the 70s and 80s, when they're like super high inflation and like, oh, I guess oil crisis would have made the oil prices much higher, but there was like no oil. I wonder where it's going to get the inflation data from. I think I should try to keep YouTube chat open. Hey, YouTube chat. Just gonna send in smiley faces. I think this is like surprisingly one of my much better streams. People seem to be quite interested in this, trying to see how ChatGPT works. This thing is insane, man. Like every time I use this and I'm like trying to build something, it just continually blows my mind, like how good it is at stuff. Like I never in a million years would I have been able to figure out all this crap. It looks super simple now that I can see it, but without doing like 1,000 examples and like writing each individual line of code and like testing it, like just getting it to the point of like having a chart on screen would have probably taken me hours, and ChatGPT just did it in like a couple of minutes. Like it's crazy. Absolutely insane how good this thing is. It is still thinking. What are we analyzing? Oh. Start 2006, pre-Great Financial Crisis for present ETFs, and today, risk-free rate 1.5%, cost basis points per rebalance, applied turnover at monthly rebalance, baseline and regime weights, SPY and AGG, XLE and DBC. What is AGG? AGG ETF. Okay, hopefully that's not a problem. Aggregate bond, okay. What are the other ones it has? XLE and DBC. XLE. Energy, select, and DBC. Commodity. Okay, so energy, commodities, and aggregate bonds. Interesting. Damn, it's really thinking, bro. He's still going. Plotting. Yeah, like this is my point. Like this would have taken me forever. This would have taken me forever to figure out back in the day. Speaking of forever, this is taking forever. Okay. Like, I want the code for myself. Can I copy this? Copy. Okay. Equity curves, regime strategy. What does that mean? Here's a complete macro regime strategy for your rule. When year-over-year inflation is more than 3%, overweight energy and commodities, otherwise 60-40. Runs monthly, rebalances monthly, and includes a small turnover cost. Tries to fetch real CPI and ETF prices. If that isn't possible, it clearly falls back synthetic data, and you can see the workflow. Change a threshold, adjust weights, try quarterly rebalancing on a moving average of inflation to reduce whipsaws. Add more assets, tips, gold, international equities. Can it do that? A macro lab, you can toggle different regimes. Yeah, sure, why not? Yes, please do turn it into a macro lab. I'd love to be able to toggle and see things side by side. Okay. Inflation. So here's our 3%. Inflation was over 3% in all of 2008, 2009, some of it, and then was not, and then went back up. This, really? This is a chart of inflation? This is so oddly predictable. Like it's like every 1.5 years it goes up and then down. That seems wrong. Fed inflation rate. Like that seems just really, really wrong. I don't know why this is loading so slowly. Probably because ChatGPT is still running. Okay. So let's change this to 2006, like my data. Yeah, what the hell? Where did it pull this data from? So it was above 3%, and then in 2009 it was below, and then it was above 3% in 2011, and then below for up until 2021, which is not what this is showing. So I don't know where it pulled this data from, but this data is wrong. Year over year. Is that not what this is? One year? Like, okay. What did it pull? Okay. Regime strategy. So it does look like, based on however it came up with this, the strategy of overweighting on energy and commodities did better than just sitting at 60-40 the entire time. So when inflation is high, you buy more commodities and energy, you tend to do better and then rebalance lower, which, like, okay, fine. But let me try to do this myself here. Backtest energy high inflation. 3. I just need to see where it got the data from for the Fed stuff, because that doesn't make any sense. Load CPI from Fred, fallback to synthetic inflation regimes. If Fred okay. Well, where did we check if Fred was okay? Import Y finance. Try. Pandas data reader. Fred okay equals true. Where the hell is it pulling? It's not pulling like the Fred information from anywhere. Download. Okay, load assets. Okay, this is random. Why is it RNGing something? Prices, random number generator for T integer synthetic. It's returning a randomly generated thing. Fallback synthetic. Oh, okay. So it returns this if it can get it, and then it returns that if it can't. Got it. Load CPI. If Fred okay. Data reader. CPI AUCSL. CPI year. So this one was definitely, yeah, this one just generated a random cycle. I'm so confused though. Like, where is it pulling the information from? For, okay, these are functions, so those are just like whatever until they're called. They call it here. Load CPI. So where is it pulling? CPI, data reader. Oh, I need to figure out what the data reader function does. What does the data reader function in pandas do? Extension of the pandas library to simply propose a data extract from various online sources. Financial data, economic data. Okay. How to get Fred inflation data using pandas data reader. I'd probably need pandas here. I need this one installed. Okay. Consumer price index for all urban consumers, all items in U.S. city average. Which one is this? FPCPI TOT LZG USA. And this one is Mamma Mia. How do you know what's what? Okay. Okay. This is not confusing at all. You can find other relevant series IDs by searching the Fred website. Identify the Fred series ID for inflation data. Okay. CPI. Okay, consumer price index for all urban consumers. And then if this matches that, oh, I see. Okay, it does match that. Interesting. But that's not the year-over-year change. Consumer price index total. What's the one that gets median percentage change at an annual rate, monthly, seasonal, adjusted? I think this is kind of what I want. But I'm so confused. This data seems pretty noisy, which I guess is fine, because it would disprove some of my data probably. Consumer price index, all items, total for United States. How is there so much data about this? Growth rate. Ay, caramba. Sticky price, consumer price index, less food and energy. Sticky price, consumer price index. What's a sticky price? I think I'm learning that I don't know that much about economics. Just shocking considering how much time I spend watching videos and learning about it. Sticky price, consumer price index is a subset of goods and services, including the CPI, that change price relatively infrequently. These goods and services change infrequently. They're thought to incorporate expectations to a greater degree. I see. So if the sticky price consumer index is changing, then you know you're in an inflationary time. Got it. Okay, I like this one. It's doing, like, this is, I think, the headline numbers. This is close enough. So let's just take this. Let's move that into here. And then do this. I don't really want the synthetic fallback, but who cares? All right. I have no idea what's going to happen when I run this. No module, Jupyter tools. Well, where was that? I really want these like reports. I just want the plots. Matplotlib. Why is it importing down there? Display data frame to user. I mean, like, I do want the plots. Ay. All right, let's import it then. Pip install. No, because then it's gonna look silly. Ugh. Okay, hold on. ChatGPT, you are making this very difficult. Let's see if this is any better. I have a macro lab framework. Cool. Let's try this one. Maybe this code is something more useful. Macro lab inflation.py. I don't want synthetic inflation data. Testing and inflation and stuff. Synthetic inflation and yield curve if read unavailable. Why do we keep saying it's unavailable? Yield curve strategy. Well, obviously the data is unavailable if you're not even trying to pull the data. Oh my goodness. Okay, we're downloading these boys. That's fine. Synthetic inflation and yield curve if unavailable. Why haven't we tried to pull it though? Return data and macro. Yay. You're making up numbers. Why is it making up numbers? Can you pull actual data from the Fed? Using this ID. Okay. Yes. Extend to include the series IDs. I just want the code. All right, I love ChatGPT sometimes, but sometimes it's just really slow and boring. Ay. I think I'm gonna end it soon. Here's how it could look. Where's the Fred ID though? What the heck? Okay. Swap that with the ID. Modify the rule. Compare against benchmarks. Okay. Would you like me to add a stats summary table? Sure. Add the stats summary table. I am very much out of my element here, but I feel like I am learning something. Okay. Let's update. Well, let's just wait for it to give me the next thing. Get assets, data reader, get macro inflation strategy, threshold 3, high inflation tilt normal regime. So this is the weights. Normal regime, high inflation. Oh, I see. SPY XLE DBC. Cool. This actually looks like it could be pretty cool. All right. Let's try this one. This one seems like it's kind of finally getting there. Great. Key error. ADG close. Data frame download 1 month. ADG close. What's the right one? Okay. So we'll use another model. Use the other model then. Come on. Do I have to do it in a new chat? Oh, man. Okay. Well, that's disappointing. I think they changed ChatGPT because now I can't even ask it anything with a different model, which is really unfortunate. I didn't know that because last time when you run out, it would like just let you use another model, but now I have to go to a new chat window and then I can type, but I can't go back to my other chats and use it. That's stupid. I don't get what the point of that is. Well, I do. They want me to pay for it, but okay. Well, I think that was enough for today anyway. I'm gonna just try to run this one more time. See if we can figure this out. I know what it was trying to do. If we just do this to close. Okay. Macro strategy versus spy. So, interesting. Seems to do better. High inflation we sold and then really well post pandemic because yeah, energy prices went boom shakalaka. Cool. Macro strategy versus the benchmark. Cumulative average growth rate lower. Interesting. But it clearly shows that it was a better strategy now. Unless the like adjusted close thing it was doing was more significant than I thought. Because here it underperforms and it starts to outperform. Oh, that's the benchmark. Never mind, not the strategy. The strategy is, I'm just looking at the chart wrong. Okay. So the strategy did not perform super well there in that case. But what if this didn't have everything that I wanted it to, right? Because it had like bonds at one point and it also had gold. So, and then we can adjust the weights here. So we have, what's the order? It's these. Oh, shit. We have these. Spy. Forget what XLE was. Energy, commodities, bonds, gold. Okay. So what if we did, so high inflation, we wanted more energy and more gold and are bonds good in high inflation? I think you would want less bonds in high inflation now. But they have more here. Actually, they have no bonds. Okay, hold on. Let's just redo all of these. Okay, so gold during high inflation, I think generally does better. So let's do like 20% gold. Let's do commodities. Yeah, fine. Energy. The whole point of this was like to test energy. So let's just go like max out on energy. And then we'll just do like some bonds, I guess. I don't really care for bonds. 2, 4, 6. That's too much. Let's do like no SPY at all. I also don't really care about commodities. So 5, 6, 7, 8, 9, 10. Cool. And then normal, we go mega SPY. We go no gold, which is fine. No bonds. Energy, no energy. And no bonds, no commodities, and no gold. Honestly, I just want SPY. Like, I just want full on SPY me up. So this is all equities when inflation's normal, and this is diversified. No, this is high energy tilt when inflation is not normal. Setting an array element with a sequence. Oh. Hold on. I feel like this should be passed in as a variable. Honestly, like ChatGPT is good at getting you the code done, but it's not the best at optimizing. At least the free version isn't. Aha. Now we have beaten it. So the buying energy stocks, aggregate energy, is much better. And then buying like S&P is good when inflation's low, and when inflation's high, lots of energy, and gold especially, I think probably helped out a lot here. Interesting. Okay. Well, that was kind of fun. I enjoyed that. Honestly, I can see this backtesting stuff being very useful. I would just be scared because like you can probably go really easily astray if you don't really know what you're doing. Macro strategy, better growth rate, lower volatility. I don't really know much. I forget what the Sharpe ratio is, and a lower maximum drawdown. So surprisingly, very well done, actually. Apparently, energy does well in higher inflation, which is very interesting to me. Anyway, yeah, hopefully that was kind of interesting. I'm really disappointed that they're changing the ChatGPT stuff, but I found this pretty cool. I also realized that my camera just died, and you guys can't see anything. Haha. Okay, hold on. Let me just change this, and then we can close up the stream for today. All right, we're back. It always goes out of focus. Okay, cool. So that about does it for the stream today. So that about does it for the video. Thanks for watching. I don't know what I'm doing with this stuff. I just wanted to kind of like test it out a little bit and learn a thing or two. And I'm probably going to continue learning about this kind of in my spare time as well, because I find this like backtesting stuff with Python super cool, and I've always wanted to do it. And now I feel like I have a better excuse to learn how to do it because I can actually run some of these programs without it taking me 1,000 years thanks to AI. So pretty cool stuff. Hopefully, if I do find some interesting strategies, I will try to bring them across. So yeah, that was kind of the idea, was like, can ChatGPT help me beat the market? Historically, yes. Obviously, the historical stuff might not end up being true in the future, which is why you have to know a lot about statistics and stuff, things that I'm not super well versed in. But I thought it was kind of cool. And all this like history related stuff was pretty cool. So yeah, technically ChatGPT can help you beat the market. You just have to also know what you're doing. So it's not as simple as that. It won't give you the answer right away, but it can teach you how to find the answers for yourself and teach the fish how to swim. All right, so that's about it. Thanks for dropping by. I will see you in the next one. Bye. And that's about it for me too from the stream. I got things to do. It is now noon. And yeah, thanks guys for dropping by. If you did, much appreciated. And yeah, I'll see you guys later.